This is your LMAX Exchange technical update for Thursday, May 18th, 2017. Eurodollar. So the euro continues to extend its impressive run, and it's important to understand where this market could be headed over the short and medium term. The breakout that we've seen over the past several weeks is a significant breakout, as it suggests that this market is putting in a longer term base and could be poised for more significant upside over the coming days and weeks. Right now, there are three important numbers to focus in on to consider where we could be headed. The first, 180. That's 180 points of consolidation off the recent high to low before this latest breakout. So the market had broken up to 110.20 about. That was a fresh 2017 high on May 8th before pulling back down to 108.40. That was a 180 point move, and so the most recent breakout to fresh 2017 highs above 110.20 projects a move towards 112 over the short term. The next number to consider is 335. That's 335 points from high to low off a recent move following the breakout that we had seen. The market pushed up to a 2017 high back on March 27th following a period of correction that took it down to lows down in the 105.70 area. That move from high to low was 335 points, and so the breakout that we saw beyond the 27th of March high, which is at around 109.05, projects gains 335 points higher, which takes us up to 112.40. Last but not least, the market has been showing signs, as we've said, of this major base in 2017 off this inverse head and shoulders type formation. The market had traded down to a 14-year low at 103.41 back in January before breaking out above the neckline, which was at 108.75. That move from the neckline down to the low was 535 points, and so the break of that neckline projects 535 points higher beyond 108.75, which exposes a move towards 114.10. So this is where we could be headed with this market in the days and weeks ahead. Ultimately, the market is looking a little bit extended here, so pullbacks should not be ruled out, but 112 to 114.10 is that area where we could be headed before the market considers a more significant corrective pullback. Right now, that higher low, the most recent higher low, is in place at 108.40. And this level would need to be broken to the downside to take the immediate pressure off the top side. On a short-term basis, key support now comes in by yesterday's low at 110.80 about, with a break below there to delay the topside pressure. But again, a break below 108.40 would be required to shift the focus back to the downside. And in the interim, any setback should be very well supported ahead of that next push into the 112 to 112.40 area. Sterling dollar. So cable continues to consolidate just above that 27.75 previous critical resistance zone that had capped gains off that plus 30-year low from back in October of 2016. The breakout that we saw in April was significant beyond that 27.75 level and now suggests medium-term upside towards the next key measured move extension at 135. This follows a period of about 800 points consolidation between 120 and 128 about, and so that break 120 to 127, and so that break now projects move back towards some key resistance, which is a measured move of extension and coincides with some resistance back in 2016 at 135. If we do see any corrective declines, which are possible, those corrective declines should be very well supported into the 125 area, with only a break back below 23.60 now, the low that we'd seen all the way back on the 10th of April, to compromise this constructive outlook. Dollar yen. So dollar yen gains have stalled out at 114.37 in recent trade, and we've seen the market roll back over sharply as we had warned in recent sessions, which could now put the focus back on a retest of the 2017 low just ahead of 108. The market now should be very well capped into rallies up towards and ahead of 113, with only a pushback above 114.37 to compromise this bearish outlook and take the pressure off the downside. Euro Swiss. So Euro Swiss rallies have stalled out ahead of a key psychological barrier at 110, and this could suggest the market getting ready to roll back over down towards significant support towards 106. At this point, it would take a breakdown back below recent support that was seen all the way down in around the 107.80 area to really put the pressure back on the downside. So right now, we're just seeing a bit of a choppy consolidation. If the market does push higher and establishes above 110, that would signal a significant shift in the structure, and open the door for more significant upside over the coming weeks. But again, while we hold below 110, there is risk that the market stalls out and rolls back over. Aussie dollar. So Aussie has seen a nice bounce in recent trade, but ultimately this is a market that has been very well capped into rallies, putting in lower highs and lower lows. And so a fresh lower top is now sought out, ideally in the 75 area, ahead of that next major downside extension towards medium-term support in the form of a 2016 lows that were seen back in December of 2016 at 71.60, only back above a 76.11. That's the high that we had seen all the way back on the 17th of April, would compromise the bearish outlook. Dollar CAD. So dollar CAD continues to retain a highly constructive outlook despite this latest pullback, which still could extend a little bit more before the market pushes higher again. Ultimately, this is a market that's unwinding from some extended readings following a push to 2017 highs just shy of 138. And so this pullback is looking for the next higher low ahead of a fresh upside extension beyond 138 and towards that next key psychological barrier at 140 further up. We've highlighted here the possibility for a drop towards the 134 area, where ultimately the market should be supported in favor of that next upside extension. But if we do see any setbacks that extend below 134, it's still viewed as corrective unless the market breaks down below 132.20, which is that level that is seen as a critical level. If broken, that would force a shift. Until then, the structure remains highly constructive with a higher low sought out at any moment. Kiwi dollar. So the New Zealand dollar has seen a bit of a bounce in recent trade out from recent 2017 lows, but the market continues to be very well capped into rallies, and this latest bounce should once again be capped well ahead of 70 ideally in favor of that next downside extension below 68.15 around that 2017 low and towards 65 further down. Only back above 71 would compromise this bearish outlook. SPX 500. The S&P 500 has seen a sharp pullback this week with the market breaking down below some key short-term support in the 2380 area. But at this point, the market would need to establish below 2322, that low that we've seen back on the 27th of March, to really force a significant shift in the structure and suggest the market is topping out. Until then, these setbacks are still classified as minor corrections ahead of what could be another push to fresh record highs beyond 2400 and towards the 2480 next measured move extension further up. Again, a breakdown below 2322 would be required to force a shift in the structure. Gold. So gold has done a really good job adhering to this base that we've been talking about over the past several months since the market was able to be supported in 2016 ahead of 1100, since making a series of higher lows and higher highs. And this latest sharp breakdown that we saw has been very well supported into this ideal area here by 1215 ahead of what could be that next major upside extension, confirming the higher low around 1215 and opening the door for a fresh upside extension beyond 1295 and towards a retest of the 2016 peak at 1375 further up. Only back below these recent lows around the 1214 area would compromise this constructive outlook for gold.